February car sales numbers have just come out, and they were unfortunately stronger than expected. The reason I say unfortunately is because automakers have increased MSRPs and dealers have added a lot of additional markup because consumer demand has been there. However, when you dig into the data just a little bit, it becomes pretty clear very quickly that the cracks are starting to form in the car price bubble. What do I mean by that? Well, when you start to break down the data, the actual growth in car sales month over month for February and year over year for February, a lot of them had to do with fleet sales. And why is that interesting? That's interesting because fleet vehicles are typically the least profitable vehicles for automakers to produce. And if they're making them and selling them, that means they have the capacity to produce vehicles. What precipitated higher MSRPs, of which some automakers, I'm thinking the Ford F-150 Lightning here, some automakers have jacked up the manufacturer's suggested retail price by 10, 15, 20, and in terms of, in the case of that F-150 Lightning, 44% year over year. And the reason they were able to do that, well, they weren't able to produce that many vehicles. Well, now that we see fleet sales rising, that's the perfect indicator. It is the clearest picture we can see into manufacturers' capacity to produce vehicles. And if they can produce more vehicles, that means more supply, and that means lower prices. And interestingly, in February, we actually did see slightly lower prices. Preliminary data from Kelley Blue Book shows that prices declined 1.3% in the month of February. That was still up 5.2% year over year. The average MSRP was actually down about 1% in February and is still, unfortunately, up 7.3% year over year. Manufacturers are starting to spend a little bit more money on incentives, up 6.3% month over month to $1,474 on new vehicles. And that the incentive spend as a percentage of average transaction price increased to 3%, the highest level we've seen since March of 2022. Pops, we are super excited. CarEdge Insurance. What is it? What do we need to know?
It's all your insurance needs in one place. Easy, simple, fast. Just give us some information, you get your quotes.
CarEdge.com/insurance. Now, while that's going on, some manufacturers are actually trying to reduce the supply of their vehicles. General Motors, for example, has stopped production of some of their Chevy Silverado trucks and GMC Sierras. Why? So that they can restrict supply. If you keep supply low, you can keep the prices high, and GM has fully subscribed to that train of thought. But like I said, when you dig in and you really start to look at the fleet sales numbers, that's where things become a little bit damning for the auto industry. So while you may see headlines that say the strength of the consumer, auto sales rise 8.7% year over year, please do not be fooled. While February new car sales were up 8.7% year over year, fleet sales were up 48%. And do not think that fleet sales are some trivial number of vehicles sold. The total number of vehicles sold into fleet customers was nearly 200,000 in February. So fleet sales are non-trivial, and the growth there was 48% versus the overall market, which was 8.7%. The strength of the consumer to purchase vehicles at these outlandish prices, these these incredibly high prices is quite low. More and more consumers are taking themselves out of the market because they simply cannot afford new cars at these crazy price points. Now, which manufacturers saw the largest increase in their fleet sales? It would be Ford and General Motors. What's interesting about these two companies is they are the companies that are selling the most expensive pickup trucks in America. The F-Series averages a $66,000 transaction price. The Silverado not too far behind it. GMC Sierra obviously nearby as well. And so these automakers have the capacity to produce more vehicles. We are going to see headlines that say consumer strength, auto sales up nearly 10% year over year. And again, the moment you dig into the data, it is because of fleet sales. However, these same automakers are the ones that are intentionally holding back inventory from the market to allow them to jack up the prices of the MSRPs, allow their dealers to charge crazy markups and things like that. These OEMs, these dealers figured out a way to make more money than ever before during the pandemic. And now that they're out of the pandemic, they are going to use that as a crutch to continue to constrain supply, ultimately harming consumers. While some automakers are doing that, we do have folks like Honda, for example, reintroducing their entry-level trims. So automakers are listening to us consumers, and they are seeing demand for their sub $25,000 vehicles. There's this incredible chart that Cox Automotive put out, and it shows the seismic shift in pricing of new vehicles. Over the past 6 years, been a 78% decline in the number of new vehicles with MSRPs under $25,000. At the same time, during those same 6 years, there's been a 163% increase in vehicles that have a starting MSRP over $60,000. Automakers are oversubscribed to the idea of building expensive vehicles, and we need more and more of them to produce cheaper alternatives for us consumers. So what's the bright spot here? Well, we did see average transaction prices in February decline a little bit. We did see incentives increase just a touch. And we are starting to see more and more pressure being put on the automakers to produce affordable vehicles because sales were actually not that strong in February. Fleet sales, which are again, the cheapest, least profitable vehicles for these OEMs to make, well, those are skyrocketing. Fingers crossed, over the coming weeks and months, we should see more and more affordable vehicles hitting dealers' lots, giving consumers a chance to actually purchase vehicles that aren't, 20, 30% of their monthly take home. You really should be seeing more options and more negotiability in the not too distant future.